Hey there, Brad Castro from GreatOptionTradingStrategies.com. In this video, I want to show you a trade on ASO, Academy Sports and Outdoors, that we did inside my private membership site, the Leverage Investing Club, in late 2024. It was a put-selling trade that went against us, but we were able to use the earnings calendar to help us repair it. With our heads we win, tails Mr. Market loses philosophy, we strive to repair any option selling trade that goes against us. Now, while we avoid exposure to an earnings release when it comes to new trades, if we're already in a trade that needs management or repair, we'll exploit the earnings calendar to our advantage. And that's exactly what we did in this instance, so that we were able to take a losing trade and turn it into a 19.13% annualized ROI on real cash secured capital over an extended 64-day period. I'm a firm believer that every trade has something to teach us or something to reinforce in us, and this is a good example of that. There's also a PDF case study version of this on the homepage of the Great Option Trading Strategies website, and I put a link in the description below for you to check that out. Okay, our approach to earnings season. Inside the Leverage Investing Club, we have something of a unique take on earnings season and selling or writing cash secured puts. Number one, we avoid entering any new trade if it exposes us to an earnings release. But number two, once we're in a trade and we're unable to exit it because we're repairing it, we'll often use the earnings calendar to our advantage. Now, before we get into that, just a few words about technical analysis. I spell out the technical setups I like best for finding new put selling trades in Chapter 4 of my complete guide to selling puts. That's also available on the Great Option Trading Strategies website, and it's free, and I put a link in the description for that one as well. Now, I've never viewed technical analysis as anything like having a crystal ball. Rather, I view technical analysis as a tool that simply tells you what's more likely to happen in the near term and what's less likely to happen. In other words, it's kind of like a snapshot of Mr. Market's current psychology. The problem with an earnings release, however, is that Mr. Market's psychology can change dramatically and in an instant, because now he's getting access to important new information. Bottom line, you can't assume the old technicals will still be relevant on the other side of an earnings release. Again, that's why we avoid entering new positions if our holding period includes an earnings report. But there is a positive aspect to earnings season, and that's that premium levels spike along with all the uncertainty. That means we get paid a lot more for selling options, or in our case, rolling and adjusting them. If we're already in a trade and it's gone against us, we're not going to exit it for a loss, except in the rarest of situations. We're going to repair it. I also cover trade management and repair strategies in Chapter 6 of my complete guide to selling puts. Again, the link is in the description below. But the number one objective we have for a put selling trade that goes in the money on us, meaning the stock trades below the strike price of our short put, is to work that strike price lower. That's conditional, however. We require both a net credit, receiving more for selling the new put than what it costs us to close out the old put, and we don't want to roll out more than 3 monthly expiration cycles. The more we can work the strike price lower, the quicker we'll be out of the trade, since the stock no longer has to come back to the original strike price. And the more premium and net credits we pile up, the greater our final profits will be. Now, as you might imagine, rolling an in-the-money short put down and out to a lower strike for a net credit and not going out more than 3 months is not always an easy thing to pull off. But it does get a lot easier if there's an earnings release included in that roll because of the extra premium available during those expiration cycles. Okay, theory is nice, but let's run through a real-world trade that illustrates the principle nicely. And it makes sense to divide the trade into 3 parts: the entry, the roll or adjustment, and then the exit. Part 1, the entry. So back on October 8th, 2024, we entered a put selling trade on ASO based on fundamentals and technicals. Now, I didn't annotate this chart here, but I did draw in a couple of lines where I saw likely support. A little below the $56 share price level, and then again just above the $52 share price level. Now, when I entered the trade, ASO had pulled back a little bit and was trading at $55.07 a share. I sold to open a single ASO November 5250 put for $1.55 a contract, which was near the secondary support level. After commissions and fees, I collected $153.86 in net premium, and that worked out to be a 28.15% annualized rate projected over the following 30 days until expiration. Part 2, the roll down and out. Unfortunately, ASO misbehaved and traded below our strike price. We gave the stock as much time and opportunity as we could to rebound, but on November 13th, a couple of days ahead of expiration, with the remaining time value and our expiring 5250 short puts pretty much gone, we had to make our next move. Fortunately, I was able to roll the position down and out to the December $50 strike for a 40-cent net credit. This move was possible because ASO was set to report earnings on December 10th, so we got a premium boost on the new December put we were selling. ASO was trading at $50.02 a share. I bought to close the November 5250 put for $2.64 a contract, and I sold to open the December $50 put for $3.04 a contract. After commissions and fees, I collected $38.73 of new net premium. Now, that was only a 7.64% annualized rate on this leg of the trade projected through the December expiration, but we gave up a higher rate in exchange for working the strike price lower by $2.50. Part 3, the exit. Now, ASO would eventually bottom around the $45 share price level before finally rebounding ahead of and then after that December earnings release. And on December 11th, the day after earnings, I took advantage of the continued post-earnings rise in ASO shares to exit the trade on the cheap and lock in some overall really good returns. ASO was trading at $54.70 a share, and I bought back the December $50 short put for just 20 cents a contract. Final book gains were $172.47 for a 19.13% annualized ROI on real cash secured capital over 64 days. Now, I'd be happy with a near 20% annualized return over a longer 2-month holding period on any trade. But I was really pleased given this one also required a repair move, rolling down and out, that limited how much new net premium we collected on the second leg of the trade. True, we would have collected more if we'd simply rolled the 5250 short put straight out to the same December 5250 strike price. And everything would have worked out fine since ASO did in fact have a nice rebound. But we had no way of knowing that would be the outcome. It was much safer, smarter, and more responsible to take the opportunity to roll down and out to a lower strike and for a net credit when the trade moved the wrong way on us. And with the new construction of the trade, the stock never had to come close to trading back to the level it had been when we first entered the trade. The stock was trading at $55.07 a share when we sold or wrote the November 5250 put. After we rolled down and out to the December $50 put, as long as ASO was trading at $50 a share or higher at expiration, we still would have gotten those 19 to 20% annualized returns. And that's a deal I'll take every time. Okay, if you have any questions about anything or would like me to clarify anything, please let me know in the comments below. And if you enjoyed this and would like more option selling resources, you might want to check out my great option trading strategies website. Again, there's a link in the description below. The site has been around for 17 years now, and you're not going to find a more comprehensive collection of free, quality option trading resources, from downloadable special reports and trade case studies to hundreds of articles on selling options for income, as well as incorporating options into value investing and dividend growth investing portfolios. Best of all, no annoying pop-up ads, and you're not going to get spammed every time you turn around. There's also a contact form on the site if you want to reach out directly. I'd love to hear from you. Okay, until next time.